Hello, this is the third of what I hoped would be only a three-part video on the state of the economy, inflation, and its aftermath. So now we're going to talk about the aftermath of dealing with inflation. I might have to make this a four-part video. As I mentioned the last time, if you listen to the news on various media outlets, you can hear all kinds of predictions, anywhere from just a couple of weeks ago, it was like soft landing. No, no landing. The economy is just going to keep on growing. We're not going to have any recession at all. To there was a consensus for the last 6 months or something about, yeah, we'll have a soft landing. We'll have maybe just a mild recession and then growth will pick up again. All the way to the doomsayers that say this is going to be worse than the 2008, 2009 financial crisis. It might be like the Great Depression, to hyperinflation, to total economic collapse, failure of the entire banking system. Okay, so what should we really expect? Well, there are a lot of indicators that you can use for where the economy is headed. You can look at things like the unemployment rate. You can look like total purchasing. You can look at manufacturers' orders. You can look at manufacturing capacity usage. Uh, you can look at inflation numbers and so on and so forth. Some of these indicators are lagging indicators. They don't help very much in telling you what's coming in the future. They tell you what has already happened. Unemployment statistics are a classical example of a lagging indicator. Just because we have very low unemployment statistics right now, it doesn't say anything about what the economy is going to look like 3 months from now or 6 months from now. That's that's lagging indicator. That's one of the last things to roll over. The bond market tends to be a very good leading indicator. And here you may hear a lot of talk, or you may have been hearing a lot of talk about inversion in the yield curve. So, what does that mean for anyone that doesn't know? Let's just go over this about bonds, because the bond market not only gets it right much more often than the stock market does, it's also a vastly larger market than the stock market. I'm talking about US bond market versus US stock market total valuation, and worldwide as well. Bond markets dwarf stock markets. The real money action is in the bond markets. Okay, so and people also get confused. I've gotten confused between the difference between uh, the U.S. Treasury, which sells bonds. The Treasury is the department of the U.S. government that is allowed to issue currency. And it's also allowed to issue bonds. That is, it issues a note or a contract essentially saying, you give me $1,000 now, and I'll give you that money back plus some interest at a future date. So it's borrowing from other sources. US bonds are a form of the US government borrowing money to spend now and pay back with interest in the future. Right. So those come from the Treasury. Now, the Federal Reserve sets the interest rates that it will charge banks that are in the Federal Reserve System. So any insured bank in the United States is for sure in the Federal Reserve System. If a bank has a sudden need for more cash than it has on hand, it can borrow money from the Federal Reserve. And there's a lot of different mechanisms, and they have different rates, but the rate you usually hear quoted is about the lowest rate that the Federal Reserve charges a bank to come to its window and borrow money. So that's something different from the interest rate being paid on US government bonds. Let's go back to US government bonds because this is where the inversion comes in. The US government sells bonds with a very wide range of maturity dates. How wide, you ask? Well, I'll tell you. They issue 1-month bonds, they're actually 4-week bonds. They issue 2-month or 8-week bonds. They issue 3-month bonds. They issue 4-month bonds, 6-month bonds, 1-year bonds, 2-year bonds, 3-year bonds, 5 years, 7 years, 10 years, 20 years, and 30 years. There's been talk, we haven't done it yet, there's been talk about maybe issuing a 50-year bond or even a 100-year bond. But anyhow, the bonds that the Treasury sells at present are dated as short as 4 weeks or as long as 30 years. Now, the rates that you usually see on this TV screen, if you're watching CNBC or Bloomberg, or maybe you hear a brief report on ABC, NBC, CBS, or whatever news that you watch, you'll see the 2-year rate and the 10-year rate. And often you'll see the 2-year, the 5-year, and the 10-year, and then the 30-year. So when reporters talk about an inversion in the yield curve, most often they're referring to the yield you get on a 2-year bill, I guess still qualifies as a bill, versus a 30-year bond. You see, these bonds they have different terminology. There's bills, notes, and bonds, and it all depends on how long you have to wait to get paid back. Okay, the shorter term ones are the bills, medium term ones are notes, and the longest term ones are called bonds. But generically, they're all just referred to as bonds because it's simpler that way, right? So the 2-year, I don't know if that's a bill or a note, but we'll just call it a bond for simplicity. So you'll see the 2-year and the 10-year. Well, if you were going to lend money to your brother-in-law, let's say, and he said, "Can I borrow money for a year?" I say, "Oh, well, let's see, inflation right now is running at about 6%. Okay, because you're my brother-in-law, I'll lend it to you at 5%. I'll give you a break. I'll just ask for 5%. But what if he says, "Can I borrow $10,000 and I'll pay you back 10 years from now?" 10 years? What's going to happen over a 10-year timeline? Will he be dead and unable to pay you back? Will inflation be running at 20% again like it was, I don't know, back in the 1970s? You have no idea. Plus, your money is tied up. You can't use it for anything else for 10 years. So it's understandable that in the global finance, normally people want a higher interest rate the longer you're tying up their money, both for the reason that they can't use that money for an even longer period of time, and because the further out the duration is, the more uncertainty there is about what the outcome is going to look like. And they have to consider, the worst case scenarios. So they're going to charge a higher rate the longer you're tying up their money. So you would expect that the interest rate that the US government is going to have to pay on a 10-year bond is going to be higher than it has to pay on a 2-year. And the interest rate on a 30-year bond is going to be considerably higher than that. This would be a normal interest rate curve that at each increase in the duration that you're giving the government your money, they're going to have to pay you back a somewhat higher interest rate. That's a normal interest rate curve. When the curve inverts, that means that for some reason, you're willing to accept your money being tied up for 10 years at a lower interest rate than if it's tied up for 2 years. What is that all about? Why would that happen? That they're willing to accept a lower rate on a 10-year bond than on a 2-year. Now, we also have to realize that the great majority of the bond transactions are not the direct sales from the US government to a buyer. Most of these transactions are parties, not like a New Year's Eve party, but entities selling these bonds to each other. US Treasury bonds are a major form of financial transactions between institutions all around the world. By institutions, I mean corporations, I mean hedge funds, I mean money market funds, mutual funds, anybody that does business nationally and internationally. If they're a major player, they're probably using US bonds as a form of payment. They're not paying in actual dollars. They're trading bonds with each other. So here's the weird thing. Inflation's running high, right? So the US government now is forced to sell its bonds, its treasury bonds, at much higher interest rates than it was selling them for a year ago, when interest rates were, still near zero, like under 1%. Now they're selling their bonds at 4.5%, 4.75%, whatever. But now, after that, players in the marketplace are transacting these bonds with each other at lower interest rates. Why? Well, because they're expecting a recession. Even though interest rates are high right now and inflation is high right now, what they're forecasting with the bond market, and that's not just the US bond market, bond markets all over the world, regardless of their inflation rate, regardless of their current economic outlook, the worldwide bond markets are willing to transact bonds at lower interest rates because they're expecting that the economy is going to turn down, inflation is going to turn down, interest rates are going to turn down. And it seems you can't take it at total face value, but the point is that's why interest rates on the longer term yields have fallen more than they have on the short-term yields. That's an alarming indicator for the future, is saying the future is not looking as booming as it is right now. So usually, like I say, you'll hear the 2-year versus the 10-year. Some economists say, well, a better indicator is the 3-month versus the 10-year, or the 2s versus the 30s. But regardless how you look, what we've seen for the last year now, for a whole year, the bond market has been inverted. Longer duration bonds are selling at a lower effective interest rate than short duration bonds. Now, that's not an indication of the current economic situation. It's an indication of the future. In fact, recessions tend to occur not while the yield curve is most inverted, but as it's starting to uninvert, as it's starting to come back to normal. Why? Because I think it's because now the rates on the short duration bonds are also collapsing as we see inflation collapsing and the economy collapsing. The short end of the curve also starts to come down, matching the long term that was already lower. So right now we have a federal funds rate of about 4.75%. And we have 2-year bonds selling below that. And we have 10 years selling below the 2 years. The only thing that's selling above the 10 years is a 30-year. Yes, a 30-year bond is still going for a higher interest rate than the 10-year, and yet still not as high as the 2-year. Okay, that's abnormal. This is a sign of real strain and real concern about recession and how long it may last. Let's look at industrial production in the United States. There's an ICI, there's industrial or IPI, Industrial Production Index. Now, the US government, or, well, the Federal Reserve, let's say, the Federal Reserve institutions try to put as positive as of a spin on this as they can, because they don't want to induce panic. But the fact is that for the last 5 months in a row now, according to the latest revisions that just came out today, for 5 months in a row, industrial production in the US has been declining over compared to 12 months before. 5 months of declining industrial production. Inflation is starting to come down. Yield curve has been inverted for a whole year. Furthermore, the depth of the inversion, that is, how much of a gap is there, say, between, let's say, the 2-year versus the 10-year, it's kind of unprecedentedly high. It's gone as high as a whole percentage point of inversion of a lower rate on, say, a 10-year than a 2-year, as much as 1%. That's very unusual. Unemployment still looks pretty good, and yet pretty much every day you hear about it, companies laying off thousands of workers. So the bottom line is what we can expect, and I think in the second half of 2023, you'll see this, if not earlier, but I think definitely by the second half, you'll see unemployment rates starting to go up. You'll see inflation continuing to come down, but still way higher than it was a year or more ago. You'll see interest rates remain high. We're going into a recession. We did have a technical recession about a year ago, first, second quarters of 2022, as I recall. GDP appeared to drop. That's the gross domestic product, the total sum of goods and services produced in the United States. Normally that should be going up year by year because population tends to rise somewhat year by year, and if there's any improvements in efficiency, innovation, and so on, then that spurs new economic activity, and we need a certain amount of growth for reasons I can't go into right now. We're not really stable at zero growth, but quarter 1, quarter 2 of 2022, we saw 2 quarters of declining GDP compared to the prior year. That's one technical definition of a recession. But by the third quarter of 2022, we saw GDP, gross domestic product, come back positive again. And it's remained positive, not really strongly positive, but it's remained positive since then. But I think you'll see gross domestic product going down again. You'll see unemployment rising. And you'll see a lot of other signs that we are in recession, and at the same time, inflation has not come down to the 2% target that the Federal Reserve wants to see. Now, for the past 40 years or something, every time we start to go into recession, or every time the stock market takes a bad hammering, which is often before the recession, Federal Reserve comes to the rescue, lowers interest rates, trying to stimulate economic activity. This time around, the Federal Reserve has said over and over again, until it's blue in the face, we're not coming to the rescue. We have no intention of lowering interest rates this year. Yes, they may have to eat their words, and the market is predicting they will eat their words and actually lower rates sometime in the second half of 2023. But that would only be because they see doom ahead. Doom in the form of rapidly rising unemployment, or a collapsing stock market, or a bunch more banks failing and having to be taken over, or some other sign of economic crisis that we can't even predict right now. But the markets are saying, Fed, you're going to eat crow. You're going to be forced to lower rates sometime in the second half of this year. I don't know if that's true or not. What I do feel convinced of is that rates are going to remain higher than they've been for 10 years, while we also go into a recession, which means that the recession is going to be a lot stronger than anything we've seen since 2008, 2009. Will the recession be as bad as 2008, 2009? That one was triggered by financial panic. I don't know. It may be. It may not be. It may be. Could it be worse than 2008, 2009? Yeah, it could be. I can't say it won't be. Yes, I think Yogi Berra said, predicting is hard, especially the future. But I'm telling you, don't count on the stock market continuing to rise through the rest of this year. Rather, expect it to decline from where it is now. I think in the second half of 2023, stock market is going to be lower. Interest rates are going to be as high as they are now, maybe a little bit higher. We might see another quarter, maximum probably 0.5% higher in the federal funds rate that the Federal Reserve charges banks. All the other rates are set with that as kind of a basement floor. We'll start to see signs of recession, rising unemployment, layoffs. We will see inflation coming down, but only because of slowing economic activity, which leads to the other point that I wanted to make. The Federal Reserve's only tool, it seems, to fight inflation is raise those interest rates. Raising interest rates slows economic activity because suddenly everybody finds it more expensive to do things, more expensive to buy a house, more expensive to buy a car, more expensive to use your credit card. Banks are forced to start at some point, about the last ones to buckle, but banks have to pay higher interest rates on deposits. So everybody starts tightening their belts, not spending as much because it's more expensive to use credit. In summary, the Federal Reserve's main tool for fighting inflation is let's cause a recession. A recession will fight inflation because people will stop spending. And then producers will be forced to lower their rates in response because nobody's buying. Well, if you're the one that lost your job because we went into a recession, that doesn't feel like the best method of fighting inflation to you, does it? Especially if the inflation was caused in the first place, not necessarily by simply a booming economy, not necessarily just by an enormous increase in the money supply, which yes, we did have since 2020, but because of shortages in materials. You know, reducing demand, yeah, it will lower prices in the face of a shortage of materials, but it didn't really correct the problem that caused the higher price in the first place. It didn't correct the shortage of materials. All it did was hammer down demand. It hammered down you, the consumer. It hammered down the businesses that have to buy goods and services to produce their things. So the cure for inflation was let's have a recession. That's been the Federal Reserve's plan since last fall. They don't like to say that. They want to see the stock market come down. They want to see unemployment rise. They want to see economic activity slow down because that's the only way they know how to get inflation down. They're not able to increase capacity. They're not able to increase production. They're only able to lower demand by raising interest rates. They're going to get their wish and more than their wish because the Federal Reserve trying to steer the economy is kind of like trying to steer your automobile by looking through the rear view mirror or with a steering wheel that's incredibly unresponsive. You turn it some and nothing seems to happen. You turn more, still nothing seems to happen. You turn it more, still nothing seems to happen. You turn a little more, and suddenly you run into the brick wall on the side of the road. It all catches up to you. The economy is like the Titanic, a huge, huge boat that has a whole lot of momentum. It's hard to turn, but boy, once it starts turning, it's hard to stop turning in that direction. Next thing you know, you're off the road, you hit a brick wall. So I don't expect the second half of 2023 to be pleasant. Brace yourselves. Unfortunately, bracing yourselves actually as individuals and as corporations, it just hastens the onset of the recession because the more the people start pulling back their spending in anticipation of more crunches to come, the more it brings on the very crunch that we're worried about. It just accelerates the downturn. Nevertheless, despite the recent performance of high growth stocks, I would not put my money there. Where do you want to put your money? Well, there's various places you can put your money, but don't expect great return in the stock market, especially in stocks that are dependent on growth and stocks that are dependent on low interest rates. Ain't gonna happen. Just expect it. I've said my piece. Thank you. And submit comments or hit the like button. All those things that everybody else asks you to do. Do those things if you found it interesting. Thank you. Hope you have a decent 2023. We'll survive it one way or another.